Hello, ladies and gentlemen. It's Modern Investing with Sasha. It's Wednesday today, and it's IBM TV. Now it's Pod TV. So I would like to immediately introduce our guests. It's first of all independent investor Peter Bennett, our contributor to the show and great, very knowledgeable man. Peter, welcome to the show.
Hi.
And also, I believe, I just wanted to say, to sing a song, just the two of us. But actually, it appears to me that there is a three of us, because from down under, we have multi-billion dollars fund manager, Shaquille Latimer. Welcome, Shaquille, to the show.
Ex-fund manager. I'm gainfully unemployed now.
You're unemployed. Well, we'll find gainful employment for you.
So we have to say former fund manager? Is that it?
Yeah, but I sort of want to be the Fresh Prince of Australia and just pretend I never had a job. Just pretend I'm on the dole on the side.
Yeah, but that doesn't give. You have to give credibility on the show. It's like I worked on Wall Street for 17 years. So
that's true.
I have too much personality to be a banker and a
Shaquille, maybe I think for you to think about it is to become a community organizer. What do you think?
That's right. I could join BLM.
That's true.
Somebody mentioned about community organizers, and my first question was, is there money in it? And people said, yeah, for some people there is a lot of money.
Absolutely.
I don't care about money. I have embraced socialism, and all I want to do is be paid in cryptos.
Mm-hmm.
I see that Bitcoin has taken another dive today. Wow.
Yeah,
what's it at, Shaquille? What's it at?
It's down 5.5%. So
is it under 30,000?
No, 34, but
34, yeah.
It's coming up. I think this 30,000 is a critical point. If it will not hold 30,000, then next level is probably 20, something like that.
Yeah, exactly. That's what I read too, and I think it makes sense. But we'll discuss crypto later.
Exactly. So the first segment of our show usually it's a high-paying dividend stocks, and this is a core of any meaningful portfolio, because if you don't have that and you're just trading back and forth or so on, I can't imagine even with my love for risk, I can't imagine doing just options or anything without a core investment, which are high-paying dividend stocks. And it's getting more and more difficult to find any new ideas in that area. So I was thinking about a week ago about somewhat to trim my position in at least two of stocks that I'm holding. One is Altria Group, and another one is British American Tobacco, for obvious reasons. But then when I started
I think tobacco companies will continue to give a decent yield. The ethics side of that is another question. But Philip Morris has had a great yield for a very long time. And I don't see the tobacco companies' yields or earnings going down substantially more than what they already have, because the push against tobacco companies in Western countries has already happened, and it's not going to get any worse, I don't think. So I think their yields are probably relatively stable. They have been, at least the last 10 years, they've been pretty stable.
But then I have an interesting dilemma. So I ruled against trimming positions because, first of all, because I'm very greedy. Second of all, when I started to think about oh my God, so the next quarter, I will miss this dividend. Oh, no.
Yeah,
I'm not going to do that.
Right, that's the problem. Where do you put money? I mean, I found some place to finally put money. We'll discuss that later in the show, but the markets are very inflated right now, obviously.
Yes.
I mean, first of all, because interest rates are so low. So everybody's in the search for, well, I could get, 0.4% in a CD. Yeah, I'm sorry, in a savings account, 0.4%. Or this week I saw the French 10-year bond, 10-year bond is paying 0.18%. That's not 1.8%, that's 0.18. Germany, if you want the 10-year, you get to pay them minus 0.2%. So you pay them 0.2% for a bond. So everybody in the world is going, who has any liquidity at all, including banks, financial institutions, individuals, they're all going, where do I put my money? So, and given the fact that, Shaquille and I disagree on this, by the way, but I view massive, a continuation of deflation coming. And Shaquille's more concerned about inflation, so it's an interesting debate. And I'm not sure, by the way. So I was told, now I'm holding 4% gold because as insurance, and I think it'll do well in either case. But I argue that deflation is coming and continuing based on four things. Debt, because every country in the world has promised free health care for an aging population. And when these debts keep climbing, like the U.S. is 27 trillion on the books, maybe 100 or 200 trillion off the books, unfunded liabilities for medical care, and other countries are the same way, then they're not going to want to pay interest on that. So they're going to do what's called yield curve control, basically buying every bond over a certain interest rate. Two, demographics. Aging populations tend to be deflationary. People, as they age, spend down their assets, and they get a lot of people in the United States and around the world. They're going to be in very tight situations because they're underestimating what they need to live. And even with a 2% inflation rate, they're going to, and especially with low yields and probably low returns in 5 years or 10 years, a lot of people will be like, hey, wait, I was supposed to retire and live in luxury. But now it's, not happening. Three, tech. And there's two angles to that tech. One, jobs, and we debate that, Shaquille and I all the time now. But I say that there's a big danger of jobs being replaced by technology. And the fourth one is, and by the way, and the part of that is the Zoom and other conferences, which we'll talk about in the show, because I have even more evidence. I've been saying for 4 months now that we're in a crisis on offices, and that it's going to hit the financials particularly hard. And every week, I have new evidence this week. Every week, I find more and more companies and evidence of vacancies, and terrible issue that's not being resolved. And the last one is any Biden taxes are going to be deflationary in the long run too, because everything he gets is just going to suck money out of the economy. And some of the uses will be productive, but a lot of it won't really help. And they're going to pull more money out of the economy than they're going to ultimately create.
You can't deny that there is a real inflation right now going, especially with the gas prices, food prices, of course. And so I can't figure out how to mitigate everything what you just said before.
You just asked a perfect question. That's Sasha, because that was the next point I wanted to make, which is there are certain areas where we're going to have inflation. And that's why my picks this week that I'm going to discuss are, one, energy. Because I am pretty sure that energy is going to be really solid for the next few years. And I saw this week, I've seen a few things this week about that. One, the average portfolio manager is only 2% invested in energy. And they have 4% in Facebook. And that's all of the energy sector. But also,
you don't say all the portfolio managers, because
what? I'm sorry, what?
Don't say all the portfolio managers. Some of us.
No. The average portfolio manager, and probably just.
Okay, we are not discussing former portfolio manager, just a real
former
manager.
Can I just address a couple of things there? As Peter said, there are things that Peter and I have differing opinions on. such as how much technology will displace workers. I'm not as concerned about that. And look, I think I said on the previous show, Tucker Carlson from Fox News, who wrote a book called Ship of Fools, which was a very interesting book and explained a lot of, in my opinion, a lot of the dysfunction of government on both sides in the United States. But it's also it explains a lot about dysfunction of government around the world, really. Right. He has a real concern with technology and automation, especially displacing jobs. And at first, I kind of saw his point, but then I sort of looked into it more, and I don't agree on that part. But I want to talk about what you talked about with inflation and deflation and yield curve control. I don't think that central banks have the ability to control the curve that much. I think they can try, but I think that as they go past the mid curve, they run into problems. And the problem is that the market can price them out. And that's actually where I think the danger is. I think the danger is that the Fed and central banks around the world can try and hold interest rates low for a long time. But when things change, the market is bigger than the central banks. You talk about negative interest rates in Germany. The interest rates across the across the EU has been negative for a little while now. And, I think that's a real problem. But let's talk about deflation for a moment. Americans can't have it every way. Nobody can have it every way. So when you're seeing these record high prices in places like New York and other highly dense, highly populated cities, you've got those prices going up, but yet you've got the cost of living going up. You've got Biden saying the other day, as he whispered, I got them 1.9 trillion. I told them, pay the workers more. The thing is that you can pay the workers more, but the cost of living has gone up. And so even in my opinion, even if you were to bring the national wages up to $15 an hour, it wouldn't really have that much of an effect because the cost of living has gone up so much already. And so what people are going to want to see is they're going to want to see a decrease in the cost of living, a decrease in the cost of the things that they buy relative to what they're earning. So what they want to see is that, hey, it was costing me $4 a gallon before. Okay, now it's costing me $10 a gallon, but instead of me earning $15 an hour, I'm earning $75 an hour. That's what they want to see. They want to see the cost of living relative to their wages go down. And I'm not sure that current government policy is going to deliver that very well. And my fear is that you'll get deflation because of hyperinflation. You'll get deflation relative to other things. So oil and gold, for example, gold, generally speaking, buys you roughly the same amount of oil as what it did 10 years ago, 50 years ago. Those prices are relatively stable. But actual currency, fiat currency, is where we're seeing the problems because that's where governments and central banks can interfere. And that's why I think cryptos are so attractive. But I don't think that cryptos are the alternative. I don't think they solve the problem. But I think that's why they're so attractive because people.
Well, I agree with you on a lot of points. First of all, you're right. There's going to be inflation in certain areas, and that's going to cause what you said, deflation because of hyperinflation. And you know what? To finish my energy point, first of all, because that was the last point I was going to make in the last part. I read that in 2019 and 2020, the energy companies put 17% less in 2019 into exploration and production than in 2016 and 2017. I'm sorry, 2017 and 2018. And in 2020, it came down a little more. So this is a famous expression in the oil and gas industry. They say low prices are the cure for low prices, basically, something like that. Because when prices are low, they stop putting exploration. It's always cyclical. So we just went through a real cyclical thing, not to mention the political pressure on where these companies are going, wait a minute, I'm not going to, over-explore when everybody's calling me, polluter, and they do pollute. But I'm just saying the whole, negativity about energy, and maybe it's going to be replaced so quickly, although it's really going to take a lot of time. And so with the low exploration and production and the world coming back from a pandemic, I believe that the next few years, we're going to see a lot of potentially higher energy. I also have a conspiracy theory I'll throw in there that the oil companies might be like tech, and tech put their thumb on the last election in many ways. It was really corrupt in some ways. Facebook really, he spent a lot of money, and it's very questionable where that money went in terms of funding local organizations. But now energy might want to put their thumb on it because Biden's administration isn't very pro-energy policy for sure. We could go into all their different policies, closing down federal lands, things like that. So closing down pipelines. So the energy companies might be like, okay, I'm not going to conspire directly, but let's see if we can get oil to how he does in the next election. If gasoline hits $4 or $5 a gallon, people aren't going to be too happy on these next elections if it keeps going up. So I think you're going to see inflation there. Plus, if interest rates are low, housing prices go through the roof because you can afford more house. It's by definition. That's why for the last 40 years, interest rates have been going down and housing prices keep going skyrocketing. So that means maybe you'll see lumber prices going up, which you saw a lot, although they recently went down. So I'm just saying that you're going to see some inflation, but there's so many deflationary forces too. So it's interesting.
With that, just a second. With that, we're going to talk more about the commodity prices. We are going to talk in next segment about the gold and bitcoins and other wonderful things. Right next.
Welcome to Swiss Impact with Banerjees. I'm Svetlana.
And I'm Ben.
In Season 2, we will be traveling around the globe, out of Switzerland, and bring amazing leaders from businesses, thought leaders, political leaders, of course investors and experts.
We're working at implementing and realizing all the United Nations Sustainable Development Goals, better known as SDGs.
And they're also making profit.
Hello, I am Amina Gurib Fakir, and I'm the 6th President of the Republic of Mauritius.
My name is Parvati, and I'm a musical artist and the founder and CEO of Parvati Foundation.
I'm Michael Lichtenstein. I'm an entrepreneur here in Liechtenstein. I'm running on the one side a financial services company.
Hundreds of deals a month. We are seeing more things happening in this impact world. And this is because, look, the world is changing.
So join us to discover impact investing ecosystem.
See you every Friday afternoon at 3 p.m. Central European Time at Swiss Impact with Banerjees.
See you on Friday. Act with impact.
Wonderful program, by the way. I've seen it a few times and highly recommend that. Now, speaking about where we stopped, don't forget that there are two things I want to mention. Number one, that American people are sitting on excess of $1 trillion in cash, which one way or another have to be deployed. By the way, all home builders companies are doing tremendously well. Some of them are doing fantastically well. So there is a huge demand on new housing, and this is may create just another step to inflation, if not hyperinflation. So there are quite contradicting cases on all that. And that can, of course, also affect the prices for commodities. And gold is one of them. And, I've read over the weekend, I've read a few articles where actually people start to notice that Bitcoin and all this ecosystem, in fact, getting some input of fresh money from the gold investors. So although there are completely two different classes of investment, as we discussed before. But some people are just thinking, okay, well, neither is paying dividends. Although in my case, it's not true. The one gold stock that I keep, Barrick Gold, I've checked today, it's paying now 4.5% dividend. So you might consider it as a dividend stock in some way. So also I'm selling from time to time covered calls. So I'm okay with, although it was downturn in gold prices lately, but my position in Barrick Gold is doing substantially quite well. And I'm quite happy with that. Shika, what do you think about the correlation between Bitcoin and gold prices?
I don't think anything about anything that is correlated with Bitcoin. Personally, I don't think there's any stability. At very least, even if you are a proponent of cryptos, at very least, cryptos are too immature. And until there is more maturity about that market, I think it's too hard to work out anything. I want to address a couple of things that you said there, Peter, about the energy sector and about housing prices, interest rates, etc. What you've said, I think, is probably, it makes a lot of sense and probably is true, but it's true as far as United States is concerned. But, is Russia going to care too much about the restrictions on energy in the United States, which drives up energy prices in the US? Probably not. Is China going to? Probably not. And I think that's where the US and the rest of the Western world really has a real risk there, because when they try and do these sorts of things, it leaves other countries that aren't interested with an advantage, and that can be a real problem. There's certainly a big future, I think. The world's definitely going there. I think there's a big future in looking for, energy creation techniques. There is obviously some drawbacks with solar and with wind, which surprisingly, or to me anyway, was quite surprising, was that Michael Moore made a documentary about this, and he's considered to be a very left kind of person, and he was quite critical of how these technologies are being deployed. So until there is some stability there, there's going to be a problem, but there is certainly a great opportunity there. And so the question becomes, well, is a company like ExxonMobil really going to do well compared to BP? If the British decide that they're going to ease some of these restrictions, is BP going to soar? Or what about Shell? Royal Dutch Shell. If the Dutch or the EU ease some restrictions or are not quite as aggressive with restrictions as the United States is, are those oil companies going to outperform companies like Chevron, Texaco, Ampol, ExxonMobil, those sorts of companies? Are they going to run into some problems? And I think that's a real issue. So the United States is, in my opinion, setting itself up for unnecessary hurt. Back to you, Sasha, with the cryptos. Look, there are correlations between lots of things, but correlation and causation are two separate things. And so the fact that gold investors may be looking at cryptos as an alternative doesn't mean that everybody in gold is doing that. It could just mean that the end of the gold investors are also investing in cryptos because that's why they invest in gold as a safe haven. Peter.
A couple points. One, I wouldn't touch BP, Exxon, or Shell. They haven't done too well. And first of all, I don't like them because they're largely oil. And oil is under attack. Coal is under big attack. Oil is next, and then natural gas. So I mean, they may do okay, but when I can own a company either shipping natural gas or creating natural gas, which is definitely a growth industry, and the forecast, if you look at EIA, the Information Administration for the World, Energy and Information Administration, that's a U.S. agency, you can look at their data, and you can see that to 2050, natural gas is growing considerably. LNG is very efficient, and here's why I know energy is going up too, because China has a gigantic pollution problem, as most people know. You have to wear a mask in Beijing, and people, you can't breathe there basically, and if you're wealthy in China or not, if you're in that area, you have a problem. So they don't want to use coal. They don't want to use oil if they can get natural gas and solar. So until they convert, it's a long process. And that alone tells you China's going to need as much natural gas as possible and as much solar as possible, because first they have to get rid of the coal and then they can go after the oil. And that's true of other countries because everybody's on the reduced pollution kick, which makes sense. And so that tells me energy is going to be around for a long time, fossil fuels, and people are underestimating it. Let's say Shell and Exxon and everything. There's also I have concerns even over peak oil issues of whether the oil will start getting expensive to get out of the ground down the road. At some point, there won't be enough oil, and there were theories about that may still come true.
They've been talking about peak oil, for 30 years. I mean, even before I was born in the 60s and 70s, if you think about it, shows like
I know.
Are You Being Served in Britain, they talked about running out of oil and the oil prices going up and the energy crisis, and they all had to turn power off.
I know. No, it's true. It's delayed, but it doesn't mean it may take 20 years, it may take 10 years, it may take 100 years, but at some point there's only so much oil in the ground. But they've developed the fracking technology, and this was a huge breakthrough, and all of a sudden they could get much more oil out less expensively. But the other side of that is, in a way, there is peak oil, because in order to get the peak oil, the oil that people need in the world right now, the countries, not just countries, companies are going out more and more to the middle of the ocean, and it's much more expensive to get your oil out of a huge trench in the middle of the Gulf of Mexico or off of Africa. And so that raises the price, and it shows you the land-based oil is disappearing. That said, again, I wouldn't touch any of these companies, BP and any of them, because I think there's much better opportunities in energy. But I think energy worldwide will be solid for the next few years at least.
I'll tell you one thing.
Just make one very quick point.
Sure.
Oil companies are not necessarily just energy companies. Oil has so many uses and purposes.
Oh yes,
things that we do with them outside of energy, and I think that's worth taking consideration. Sasha.
Just before we go into the next segment, I would like to mention that there is a case that, if Peter, you're right, and energy prices will go up considerably, and gold prices, there's a case that gold prices can move higher from this level. It's quite the case. Then the perfect play on it is the Canadian dollar, because when both gold and oil going higher in price, Canadian dollar is going higher. That's been
yes, you're right. Absolutely,
it's the same with the Australian dollar as well.
Yes, I was about to say that exactly. The Australian dollar and the Canadian oil have large correlations to energy prices because they're energy producers rather than energy consumers.
Interesting trade actually between the Aussie dollar and the Canadian. The first time I went to Canada, the Canadian dollar was trading one Australian dollar to $1.10 Canadian, and when I went back to Canada, it was 90 cents Australian a dollar Canadian was $1.10 Australian. But as a general cross rate, you tend to find that it will sit. It's not always this way, but as a general rule, the Aussie Canadian will sit somewhere between 90 cents and $1.10 against each other.
And don't forget one more thing, that if next election in Canada the Liberal will lose, and maybe that's the case, then Canadian dollar will skyrocket.
Well, for the sake of all Canadians, I really hope that the people that live on the prairies manage to convince the rest of the city dwellers to get rid of that muppet that you have called Trudeau.
Well, it's coming. It's coming.
You know what? I want to mention gold for a second. That gold is a dilemma to me. I've held 3%, now I'm 4%, because if we get massive inflation, and if the governments lose control of the debt, it's going to be terrible. And so it's a good insurance. That's how I view it. Because as I said, it could happen. It could happen that maybe they won't be able to control the yield. They have in the past, by the way, for the U.S. for 11 years, bought every bond over a certain interest rate. Japan did in 2016 and brought their rate down to zero, and it's never come off it. But maybe they won't. But to me, they can keep printing money as long as they want to buy every bond, just like they're buying 1/3 of the mortgages in the United States already. But that said, if there's deflation, gold could go either way, because people might think, I don't need it as an insurance, or it could be a relative value trade, where if interest rates are actually very, very low and you get no return, maybe gold just keeps up with that inflation, whatever it is, 2%, even if it's low. Inflation, I think, is definitely going to be higher than interest rates for the rest of our life.
You know what I will really start to worry about gold? If buried gold will start buying bitcoins. Then I will become very worried about the gold. Well, with that, I would like to announce our next segment of the program. It will be options as a way of preservation of capital, coming up next.
And Keidre goes, let's go look at something that took place 40 years ago. Who cares? Okay, that's political.
Another high quality program on IBM TV, now Pod TV. I enjoy watching these programs. So let's now talk about the options as a way of preservation of capital. And so we are discussing basically two very simple way of using options. Although there are billions of ways to use options, and Shaquille knows about that quite a bit, and he's extremely experienced that. And of course, Peter using a lot of different strategies there. I was thinking about, remember in the first segment of the program, we discussed high-paying dividend stocks. And now I was thinking about using options. I've done it before. For example, selling protective covered calls on some of my high-paying dividend stocks. And I have pretty good experience, actually. I've never lost money on that. But once I was very upset when I had shares of Canadian Imperial Bank of Commerce. And on 29th of March, I think, I was expecting my usual dividends, and on 28th I was exercised on my option, and I missed this quarter's dividend.
So the bane existence of every covered call.
Sorry,
I said the bane in the existence of every covered call trader.
Right.
Yeah, so this is kind of it's not like a really little case, and I survived that. I ended up making money on that trade, but that's the danger of that. On the other hand, it's a great enhancement of high-paying dividend stocks, and I'm thinking more and more about using that, especially if, as I expect, the market may go down. Nobody knows when, but at least some, I don't know, 5 to 10% correction. It must occur. I've never seen a market will go higher and higher month after month, year after year, or so on. It's never happened. But okay, so my protection mainly consists now of TZA. It's a triple bear on Russell 2000 stocks. Of course, it costs me money because as market moves up, this comes down. So I'm selling all the time covered calls in that position. So at least it mitigates. And again, I use it as a protection. And another idea is, for example, if you want to add to your position or initiate new position, instead of just go in and buy the stock, you may sell put on that stock. And if it's hit, I've done actually a few times with MPLX position.
Really?
And, I'm missing. I'm doing well on the trades. I keep the premium all the time because of course the puts are expiring worthless. But I have very few shares. I have 1,500 shares on there, and I wanted to build it up to 5,000 shares or so. But well, I will end up using my profits on options and just buy the stock. What else can I do? Peter, what do you think?
A couple points. One, I mean, people do very well selling calls as just as an income source. But personally, I like to buy a stock, and I'm not Warren Buffett, but I like his philosophy of like buy a business that works, that keeps growing, especially if it's going to pay an increasing dividend. I don't want to give it up for anything. And I don't want to get
Warren
into
Buffett never pays a dividend on his companies. Berkshire Hathaway, for example.
I know that's true. He doesn't, which I wouldn't buy his company because I look at the duration, basically that concept, and say my duration's endless, and who knows what happens in the future. But so I don't want to give up these businesses that I worked so hard to find, because it's like, okay, if I bought a pizza parlor, I'm not selling it, if it goes up to a certain price. So I want the income stream for life, and so I don't want to. That's my philosophy. I'd rather sell puts because, but there is a benefit. And before I get into the selling puts and what I've been doing, because I did a few moves this week, the selling calls and TCA may be very interesting. I don't know if I would necessarily do it, but TCA is one of those things that those funds that works on derivatives, and these derivatives have a role, and it's a little constant. I don't want to spend too much time explaining it, but basically they buy, they're buying futures, and because of that, they're paying the price for the future, and they're paying a premium. Then each month it rolls into a new future, so they immediately start losing money, even when they might be making the right bet. So I heard somebody on this program, for instance, talk about a derivative investment once, and I said, wait a minute, he thinks that this is a good investment because he likes the underlying concept, whatever it was at the time. Let's say it was oil, and he was buying a derivative on oil. But the problem is you can be in the right investment, but because of this role, you really have to be careful of if they're not buying the actual thing, they're buying futures, you're going to get killed potentially on premiums. So TCA might be a good one to sell calls on, because if everything stays the same, they'll probably go down anyway.
Well, this is what happened with a lot of the, the multiple time, like the 2-time bear and the 3-time bear ETFs.
Yeah.
They had such huge tracking errors, and a lot of the times it was because they had to use other derivatives and synthetics to create the position. Can I just quickly address what you're talking about now, and also
Sure.
the last as well in relation to gold? I've been saying for a long time that I didn't really see why gold was a safe haven. But I've got to tell you, last year really scared me, I have to say. Well, not scared me, but rattled me a bit. Because last year what we saw was things that were usually negatively correlated, such as the market versus bonds, the market versus gold. We started to see all of these instruments moving in unison.
Yeah.
And that, to me, indicates that something fundamentally has really changed. In 2019, we saw the yield curve invert several times. And generally that indicates that you're heading for a recession. And obviously they're going, oh, maybe it's just because of the political tension, because Donald Trump's there, and the very difficult presidency that he's had at that time, had so far. And yet we end up with COVID, and the market took that huge big black swan event, and it fell 30%, 35%. Of course, it rebounded pretty quickly. But you sort of ask yourself, what did the bond traders see that the rest of us didn't see? Because it just proved them right once again, even when looking at the markets as a general concept didn't indicate that. I've never been a fan of covered calls, but one of the things that I would agree with is when people say that gold is not a great investment because it's no yield, or it's a negative yield because you've got to pay to store it. Using covered calls can be a great way of enhancing that trade. If you're going to enhance a yield-paying stock, perhaps a stock that doesn't pay much of a dividend can also be enhanced by the use of covered calls. I would suggest that you could use bear call spreads if you didn't want to lose the stock. That's a good way of doing it, because if you get exercise without hitting your bought leg, where you just buy the position again and you don't have a problem, or you buy back the call that you sold. But the proof in the pudding that disproves my dislike for covered calls is the fact that the S&P 500 buy right index. The S&P 500 buy right index has outperformed the spiders forever. Like, they always seem to outperform them.
So Shaquille, are you saying, and I'm really interested in this, you're saying, first, well, before I even ask the question, are you saying you don't like gold at all? You do believe in the potential for hyperinflation, in which case wouldn't gold be a good asset?
I'm not saying that I don't like gold. I like gold, but I don't like gold for a lot of the reasons that are given by the general public.
Oh.
And I don't necessarily like gold as a safe haven against inflation. Generally speaking, gold tends to be that way. Yes, gold does operate that way.
You're right.
But I don't think that fundamentally there is any reason for it to work that way other than irrational human belief.
You know, I agree with you, and sometimes I wrestle with it. You know, I went from 3 to 4% gold, and it's just sitting there. It goes up, it goes down, but I wondered myself because my forecast is actually for inflation in certain areas, a lot of deflation in other areas, low interest rates. But then again, you know, it is a diversifier. So to have a little bit, I figure, you know, I can afford to have 3% sitting there not getting dividends if I'm getting, you know, dividends on everything else, and you know, have put positions that I'm selling that have done very well and everything. So to get back to the puts, I just want to get more specific about that. So this keeps happening to me, but it's good. But I always like to sell puts, and I sell very long puts. So I'm selling 2023 puts because you can get a huge premium and actually buy the stock cheaper. You know, then it's
you're getting very low levels of theta. Why not do short term puts if you like the premium?
But you know what? If you add up all the short terms, you're right. But if you add up all the short terms, it adds up to about the premium on the long term. And this way, I just lock in the big premium. It's very big premiums. I mean, you could get hundreds of dollars on on an Amazon, for instance. You can buy it lower, and then you get the cash to use. By the way. Although you have to watch your margins and, you know, not use too much because you can use up all your margin power and get a call if it goes against you. But so you should always leave at least 10. I always warn people selling puts uses a lot of margin power. So you have to keep always at least 10 or 20% of your portfolio in you know, buying power in case it goes against you. But so for exact examples, first of all, NVIDIA, which I got from Sasha, you know, months ago. Hallelujah. I mean, I had 600 puts and I sold them at 400. And I sold the 600. I bought 400 to protect, but because I've had so much experience with it, well, it's going through my price by so much, I'm missing a lot of the profits. I rolled them to 800, especially when they announced the 4-for-1 split, and now it's at 800. It was at 797 yesterday, which is beautiful. Except for now, I have to wait till 2023. So I'm going to see if the ARM deal goes, and if it goes, I'll roll it. But I've already made 33% on those puts, and if it just stayed at 800 and I did nothing, I'd have made a very nice premium.
Actually, I had also 600 on NVIDIA, and I rolled them into 850. So
maybe I should move to 850. I'm waiting for the I want to see the ARM deal. The ARM deal makes me nervous because it's not approved.
At 600. When you sold puts at 600, you did a bull put spread. You sold them at 600 and bought them at 400.
No.
That's what I did. That's what I did.
That's what Peter did. What was the price of the spread? Do you remember?
I don't remember, but it was. I got like $100 or something for the 600s, so it was like as long as it stayed. And I hardly paid anything for the 400s. So and now. The 800s I had sold and it was at 150 and now it's at 100. So I already made, you know, and the 400s weren't that much. So it's a long look. I don't know where the market's going in the short run. That's another answer to your point of why I'd rather go long. Look, with volatility, what if it goes down? You know, what if I do a September and it goes down and I get killed on the short-term position? First of all, I didn't get the big premium, but also I'm not going to want to roll it again. You know, I'd rather, because I'm more confident in these companies in the long run, and I don't want to worry about volatility. So I moved to the 800, and now I'm waiting to see about the ARM, but I'm wrestling with the fact I'm going to make 100% on my money, and it was $150 a share. But the other side is maybe I need to move to 850 or 900, so I'm watching it closely.
Peter, all the theory and all books about the options suggest that if you are selling, you have to sell as close expiration date as possible.
Yeah, so I know that's a theory.
Because you have that
it's not true.
No, it's not true.
They say that because you've got that exponential increase in theta.
Exactly.
And I think that's really based on the idea that if you're selling puts, it's the equivalent the synthetic equivalent anyway, of selling a covered call. And a lot of people, when they first start out learning options, learn about selling covered calls in the front month in order to get in that sort of extra income, and they use it as an income-based strategy. And a lot of people will say, and I think you said before, Sasha, that it's a less risky trade. I don't believe it is, actually, because whilst it does slightly decrease the risk of just having bought the shares outright, it also decreases your potential profits. And so if you compare risk reward on an equal basis, I don't actually think that a covered call offers that much. But I do think that spread trades is a good way to go, especially for people that are starting out.
Yeah, and you know what?
I agree. And I did very good spreads on Zoom, for example. I've told about it on the previous programs where I sold, I think it was at the time, I did some adjustments to the position, but I sold initially 510 put on Zoom, and I sold also 480 call, the same expiration date. I think it was June 22. Expiration date. So I got fantastic premiums on both puts and calls. And now my theory is that if, let's say, a Zoom will run to $1,000 a share, is it possible? Yes, of course. But then I will be exercised on my put position, and I sold covered call essentially, because by the time that my call will come to expiration, I will have already 500 shares of Zoom to cover the sold.
Only if it dipped first, if it just went straight up to 2,000, you'd end up in a position where you're short 500 calls at 480, and your 510 puts never got exercised, never got assigned, or never got exercised.
Okay, you're talking about, well, my 510 puts will not exercise. Well, that's
if you've sold 480 calls and you've sold 510 puts, and the market went straight up, there's been no reason for your 510 puts to get exercised, but you'll be
well,
assigned.
Of course, I'm watching the pattern of trading on Zoom. It was as high as close to 600, 575 or so, but then it went down to 300, some 320, and it stayed there for a long time. Now it started to go up slowly, but again, slowly today it's down a little bit or so. And so by the time that see, I've got such a huge premiums that indeed I may lose if it will one day move up to $1,000. It's a possible scenario. I would.
Are you going long term or are you going shorter term?
Long term, no long term.
Yeah, exactly. See, that's why I like the long term, to get more basic for the viewers. When you get a big premium sometimes, and you're buying the price, and you're buying the stock much lower than it is now, you have a pad. In other words, let's say I sell a put, and if it was exercised or counting the premium, I'm buying the stock maybe 10 or 20% lower. Now, if it's a growth stock, then I feel pretty good about it in 2 years. A company, but you have to be confident in the company. I also did Microsoft. I had to go. Okay. Do you have any last words, Shaquille? It sounds like you have to run.
I've got a couple of minutes, and I'm going to take this call.
Okay, with that we will end up this program. And the next will come our recent trades and what is on our radar coming right next.
Bye.
Welcome. Today we're going to look at a unique tax planning opportunity using life insurance to create huge tax deductions for 2020. So listen up to this not well-known plan called 412E3. Today I have a very special guest, Max Culiet, who's a certified financial planner and a registered investment advisor to help us with understanding 412E3 plans. Max, welcome to the show. What is a 412E3 plan?
Well, thanks, Nick. Simply put, a 412E3 plan is a pension plan that has to be funded solely with qualifying insurance, life insurance, and annuity contracts. The contributions to the plan are fully deductible for federal income tax, state income tax, so most of the time Social Security tax and Obamacare taxes as well.
Well, Max, I have a client right now. He's facing a $100,000 tax bill, $100,000 in 2020. Is there anything that you can do for him today?
Sure, Nick. The Secure Act that was passed a while back allows us to set up a plan in 2021 to deal with the tax year 2020. And in many cases, you can deduct 100,000, 200,000, 300,000, perhaps even more based on an actual calculation.
Max, did I hear you right? You said you can deduct $100,000. I thought you were limited to $19,500 in 2020. How did you get to a $100,000 deduction?
It's pretty simple, Nick. The 19,500 is a 401k limitation. Every plan has its rules. Profit sharing plans have a limitation of 57,000. But a pension plan is actuarially determined. And it can be well over 300,000 depending upon the math and the circumstances.
Well, Max, I want to learn more about this plan. How can I find out if this works for my clients?
Well, the best way is to give us a call. My number is 877-252-1692, or send me an email. We can certainly set up a go-to meeting, and then we can talk about your client, the specifics, the needs, etc., and design a plan that fits their needs and their budget.
All right, so I will have to go, I'm afraid, to our audience, as Peter was alluding to. And also, I can't participate in this particular section anyway, because it's about reviewing our own personal trades, and obviously I can't participate in that. But thank you for having me, and I endeavour to see you guys next week.
See you. Thank you so much. Bye-bye, Shaquille.
Bye-bye, Shaquille.
Well, with that, so our recent trades and what's on radar. I was watching today CNBC, speaking about what's on radar. There are some bunch of new IPO stocks coming to the market, some kind of Chinese company, Didi or Dada, I forgot its name, and some other bunch of stocks. But what this guys admitted that although average return on IPO stocks is some 26%, which is not so bad, but all these gains are on the first day of trading. Now, if you're going on the second, third day of trading and further, there are no gains for retail investors, actually. So I don't know. I'm staying away from the stocks. I'm quite curious about that, but I never tried it and have no plans. What about you, Peter?
I heard an interesting point. I don't really understand it fully. But today on, it might have been Maria Bartimaromo, one of those shows I watch. But she was saying that, I believe it's her, that the U.S. shouldn't be allowing the Chinese IPOs, and that we're actually funding China that way. And they should create regulations. And it makes sense to me. I mean, China is not our friend in many ways. They're not acting like our friend in many ways. And they're projected to grow to a bigger economy than the U.S. at some point in the next 10 to 20 years or so. So if they're not friendly, why are we giving them money for IPOs, especially when their market is very shaky? I don't touch it because I had experience once with them, but it's very shaky because of their accounting rules, their lack of transparency. The government can change on a whim. So I don't need that risk because there's enough risk anyway. So I stay away from that.
Yeah, but when you see big companies like JP Morgan or Morgan Stanley, when they support this type of IPOs, and of course,
of course they do. They make money.
So the name of the game is to make money, not necessarily politically.
Just like Nike makes money on slave labor in China, it's like doesn't bother them. It's like they pretend to be so moral, but their actions, follow the money. The old expression, right? Like the Watergate, follow the money.
But if you would look into Chinese company, I think far as the best is, and I used to make some money on options on Alibaba.
I don't know.
Huge premiums and
Alibaba did very well.
Yeah, but they had some problems with, believe it or not, Chinese government.
Yeah, exactly. That's what I don't want to support it, for so many reasons. And, but I hope they crack down on some of the IPOs and funding. It's like, why are we helping them, But then again, they'll just sell some of their massive treasuries and you get the money that way, which is just the U.S. because we have so much debt anyway, although most countries do. So, since we have limited time, I want to talk about some dividend stocks because So I did a couple of moves. I'm saving a few for next week because, I only like to cover maybe 2 a week. But I found an interesting company where I put a 0.5% in. I expanded one of the other ones, and we'll talk about that next week. But this week I'm going to talk about 2. One, I made a major move in a way. I went from 4% to 6% on TRP, which is TC Energy. I love this company. I mean, I'm 10% MPLX because it went up so much. It still pays a 9% dividend. It's a partnership, but and MPLX has been fabulous, and I believe in it. It's easily covering its dividend and probably going to be paying it and more in the next 20 years. But TRP is a good second. First of all, I view it. It has a 5.7% dividend. It's 80% natural gas, which is the way of the future. It provides 25% of the natural gas for the United States, Canada, and Mexico right now. They had been doing the Dakota pipeline, so it was controversial in the news, and the Dakota pipeline got killed by the Biden administration, and that project is dead. But their performance, which I'll talk about in a minute, has been consistent throughout this. So they've been pumping money into the Dakota pipeline now that they can redeploy. And they've still been doing the following. They've from 2000 to 2010, they doubled their dividend. From 2010 to 2020, they doubled their dividend. And if you look at TD Ameritrade, I don't know if this is right. They say they've been increasing their dividend 14% a year for the last 5 years. I don't know if that's true or not, but they're a steady revenue grower. And here's the thing. I view it as a utility because it's very long contracts and it's very regulated. Most of their business is regulated, long-term contracts and regulated. And also, people need natural gas, and it's not changing tomorrow. So if I can get a utility paying 5.5% growing, I love it. So I went with 6%. And by the way, yeah, and I put it mostly, I have a Roth IRA. I mostly put it there because I wanted to grow tax-free. What were you going to say, Sasha?
There's one major problem with TRP. You know which one?
What's that?
Yesterday it went ex-dividend.
Yes, it did go ex-dividend, but the price went down. And I bought some yesterday. I bought a little more today to round off the shares. And it doesn't matter to me because, and by the way, it's down $2 or $3 from the high. It was at 52. Maybe it's at 49.50 today. But you know what? I don't buy it.
It doesn't matter. Actually, maybe
it doesn't matter to me because I try to find stocks that are, I look at 10, 20, 30-year horizons. And in this environment, with changing demographics, with huge national debt, with all the other issues, with technology potentially taking jobs, it's very hard to find sectors or companies that I feel are real safe with growth and dividends. That was an old joke I had. All I want is growth, value, and dividends in my stocks. But this is very hard to find. But I think it's very safe. You know, I don't think it'll go down a lot, and I think it'll just keep growing. It already has projections to keep growing. They have lots of growth projects, and their cash flow yield is 8%, so they easily cover the 5.5%. But that's including all the growth projects they have. So they're redeploying that Dakota money right away. They'll just keep growing and growing, and in 20 years, 30 years, I expect to hold it because I think in 2050 we'll be using as much natural gas as we are now, if not more. An interesting point, which is hard to explain, is I saw the typical graph where it shows the mix of products and the projections, and it shows like natural gas, in 2050, as about flat, oil going down, coal going down, solar going up. Of course, this is what we see all the time. But then I saw projections and the past also of the actual usage. So oil may look like it's going down as a percentage, but because the world keeps using more and more energy as the population grows, I mean, we're projected to have 9 billion people. And also as undeveloped countries keep developing, they use more energy. So it might look like, oil is going to be a tiny fraction, coal is going to be even smaller. But the truth is, oil might stay flat for the next 20 or 30 years, at least 10 or 15, because the usage is going up while the percentage is going down.
Exactly.
So, but in the end, why not natural gas? Because the usage is going up and the percentage is at least flat and most likely going up. So
Peter,
it's very
it's an excellent suggestion. I've looked at this actually in the last few days, because you mentioned that stock a week ago.
Yeah, when I was 4%.
Yes, it's doing really well, and I think it's fantastic opportunity for long-term, high-paying dividends investment idea. I would like to add some to my position in Pfizer. I'll tell you why. I've heard that it doesn't pay really high dividends. It's 4 something, 4.7, 4.8 maybe. But Pfizer, interestingly enough, on this drug, coronavirus drug, Pfizer really didn't move up substantially. It was about a year ago, probably $36, $37. It's 39 something. But what's interesting is that this drug is not only against coronavirus. Actually, it can cure many different illnesses. So it's kind of a long-term play. And otherwise, Pfizer is a very well-financed company with several patents in different areas. So this stock, and in the same area, AbbVie, ABBV stock. I think it's high-paying dividends medical stock. It has also a lot of patents. It's about 112, 113 level, and I think it has a long way to go. Also, these two companies, in my opinion, they're in the right sector of the market. They're not so subject to hyperinflation or deflation scenarios or so on, because with a growing population of growing older people and so on, I think their drugs will be very popular.
My question would be this, because I'm always afraid of the drug industry a little bit, because is there a way, because I don't have expertise in drugs, and it's just an area I've always been a little cautious of, because initially I thought there might be big attack by the government in the United States, among other things, where they make a lot of money on, the drugs, and it's still questionable if there'll be changes. But what about the expirations? Like, this is something that do you look at that, or is there a way to look at that? In other words, what if Pfizer has in 5 years a major drug coming off and it's going to go generic, or AbbVie? I mean, I don't know the drug business to even answer. Is there an easy way to find that out or figure it out, or it's so complicated it's hard to
it's complicated. You have to be an expert in either medicine or sciences or medical sciences, so again, I don't want to sound like I'm an expert, and I just have all accessible materials, what I've read, and the stock pattern, to me, the tape is...
Well, the technicals can tell you a lot. Plus, relying other experts can tell you a lot. I mean, there's no doubt about it. That's, if I was looking for one additional sector to add, it might be that one. But I like to understand what I'm getting into, and I don't know if I can, but maybe I'll look at those drug companies.
Yeah, look, and we'll discuss it on our next program.
Yeah, what? I had one other energy pick, but we'll save that for next week too, because I think we're out of time.
Great.
But TRP is worth it itself. It's I love it.
Thank you, Peter. With that, we will finish today's program, and we wish you all successful.
And that's TC Energy, by the way. The company's called TC Energy.
TC Energy. Okay.
Yep. All right. See you next week, Sasha.
See you next week. It's Modern Investing with Sasha. Thank you very much, and we'll see you all next week. Bye-bye, everybody.